Teladoc stock is up 23% in the past month, even though it has been dropping a lot in the past year. Hello everyone, welcome back to the channel. Today we are going to talk about Teladoc, their earnings report, the stock performance, and what is expected for next quarter. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. Now we can see here that certainly the stock is up 23% in the past month, but in the past year it is still down 20%. As we can see that the stock actually went up massively during 2020. It went up over almost 300%, and it has been going down since then, and it is down 46%. Even though the growth seems to be only since 2020, we can see that the stock was already growing between 2016 and 2019, 337%. So this is certainly not a new stock that's going up. Now, the stock is currently trading at $151.53 per share with a market cap of $24.24 billion. It has a current price to sales ratio of 11.98. But let's talk about their financials and see how they did. First of all, they put a revenue of $522 million, which grew 81% year over year, and they were able to update their 2021 guidance to 2015 million to 2025 million, up from 2000 million to 2025 million dollars. Now they announced a significant new agreement with CVS Health and Centene to provide Teladoc Health's Primary 360 in order to deliver greater care access and health engagement by remaking the primary care experience. Percentage of chronic care members enrolled in more than one program has grown 3x year over year to 24%. Total visits grew 37%. But still, when they reported earnings, we can see that the stock actually went down after our 6%, and then it started going up in the next day. It is up 14% since they reported earnings, and we're going to see why it first went down and then up, because in my opinion they reported really good numbers as they were finally able to beat analyst expectations. As we can see here, this is something that I was worrying about before, that they were missing quarter over quarter, and this quarter I said that I was going to wait to make a decision with this investment and see how they were able to finally beat analyst expectations. Now the revenue grew 81%, as you can see, which obviously is very impressive because many said, or many thought, that Teladoc was only a pandemic product, that after the pandemic it was going to decrease as people were going to start going physically to visit the doctor, which is completely true. But this demonstrates that many enjoyed the service, which is why it's very impressive to continue seeing this kind of growth after the pandemic. Now their access fee grew 99% and their visit fee 18%, which even though many don't like that the visit fee is not growing that much, most of the revenue comes from their access fee. As you can see, $452 million comes from access fee and $60 million only from visit fee. We can see that their utilization has been growing quarter over quarter. It was at 16.5% last year, and it's already at 23.7% this year. Now let's get to the fun part. We can see here that their access fee, we know that it grew 99%, 113% in the US and 19% in international. Visit fee 18% in US, 22% international, and the rest it's actually decreasing. Now as I said before, most of their money comes from their access fee and not from their visit fee nor other. Now many did not like that their US paid membership only grew 2%, which might have been one of the reasons of why the stock dropped at the beginning, as well as the US visit fee only access grew only 8%. But again, most of the revenue comes from access fee, so it is very important for us to continue seeing this grow. Now, as always, this company is not a profitable company, and they said that their net loss includes a stock-based compensation expense of $71.7 million, which is an increase of $50.8 million, and it substantially reflects higher expenses associated with Livongo stock awards that continue to vest after the merger. So remember that merger that they did with Livongo, they're still paying stock-based compensation and expenses associated with that merger. Now we can see that their balance sheet looks pretty nice. They have $1.1 billion in total current assets and only $302 million in total current liabilities. Now, even though this seems to be incredible, $17.6 billion in total assets, I don't like to take into consideration goodwill and intangible assets, which is $14.4 billion for goodwill and almost $2 billion for intangible assets. So yes, in the short term, current assets is very nice, very good, high, $1.1 billion, over $302 million, but total assets, I would not take into consideration goodwill and intangible assets. But here is the fun part. We can see that the revenue is growing 80.6%, as we said, 81% year over year. And their cost of revenue actually only grew 61%, which obviously it grew a lot, but not in comparison to the revenue. As we can see, it grew 80%. And we're always going to see this cost growing, but we expect it not to grow that as much as the revenue. The thing is that total expenses grew 88% from $308 million to $582 million, a growth of 88%, meaning that yes, certainly the revenue is growing, but the expenses are growing faster. But we do have to take into consideration that most of these expenses, or a lot of these expenses, not most, a lot of these expenses are from stock-based compensation, which we're going to see later. Now, I said it here an asterisk, as I said that the advertising and marketing grew 112%, and as I said here, with this growth in marketing, we expect revenue to grow more, because normally companies expect to invest $1 in marketing and get back $2. So if their advertising and marketing grew 112%, they're expecting the revenue to grow more than this. And I also said that the revenue is growing, but expenses are growing faster, but still they were able to report a net loss of $84.3 million, which was a 53 cents earnings per share, which they beat analyst expectation, as I said before. Now, something it is very important here is that shareholders have been substantially diluted in the past year. As we can see, their shares went from 83 million to 157 million shares, which obviously I know that they have been diluting us because of their merger with Livongo and their agreements with other companies. But this is something that companies do not like, and might have been another reason of why the stock dropped that much after they reported earnings, because investors or shareholders don't like to be diluted by any company. As you can see here, we can certainly see that they had a net loss of $417.8 million in the past 9 months. But we can see that their stock-based compensation grew from $61 million to $240 million, which obviously is a huge expense for the company at the moment. Now, here's the stock-based compensation. We can see that this quarter they had $71.7 million in stock-based compensation. And as I said, Teladoc almost profitable without stock-based compensation. And this next quarter, quarter 4, should decrease, because as you can see here, they had a total compensation of $71.7 million. And if we subtract that from $81.3 million that they had in net loss, it is still not profitable, but it is almost profitable. Now, for their expectations, they updated their expectations for the whole year, but for the fourth quarter, they're expecting a growth of 40 to 42% in their revenue and a net loss per share of about 73 to 53 cents per share. Now, for the whole year, they're expecting a growth of 84 to 85%, which we can see that their guidance was updated in comparison to the previous guidance, but still they're expecting a net loss of about $3.40 to $3.20 per share. I want to talk about ARK Invest. I know that many of you know what ARK Invest is, and this is a management firm that is managed by Kathy Woods and many other. And this firm mostly invests in companies that are innovative, that are disruptive, and that are having a nice growth, and they're doing something very impressive. So this company invests in Teladoc. As you can see, their main ETF, which is ARKK or ARK Innovation ETF, has as a second position Teladoc, right after Tesla. We can see that Teladoc represents 6.86% of their portfolio in this ETF. Then for their ARK Next Generation Internet ETF is this their fourth biggest position with 5.58% of their portfolio. And then lastly, for their ARK-J with the Genomic Revolution ETF is their highest or biggest position, which represents 8.83% of their portfolio. So they mainly have $1.4 billion plus $308 million plus $645 million invested in this company. And Cathie Woods or ARK Invest have been investing heavily into this company in the past years as the stock has been dropping massively. And every time the stock drops, they are buying this company because they believe in the potential that this company have, even though many believe that after the pandemic, it was going to decrease or see a slowdown. Now, analysts are expecting this stock to go on average up to 165%, which is at 8.9% return, or as high as $260 per share, which would be a return of 71.6%. Now, we can see that they actually believe that the stock is undervalued by 12.4%, as their fair value for them is $172.94 per share, which is currently $151 per share. Now, this company is not profitable yet, as we can see here, and it's not expected to be profitable in the coming years. As we can see that in 2023, they're expecting to have a net loss of $131.58 million, but they're certainly expected to be profitable in 2024. I do have to say that if we continue seeing this growth year over year in revenue, and they continue investing into their company, they continue diversifying, they continue growing, and they continue focusing more in the growth of their company, we will going to be able to see them be a profitable company. And even if they're not a profitable company by 2023, it should be because they're investing in their company and not because they're spending money anywhere else or because they're having problems. That is something very important to take into consideration. As I said here, Teladoc is forecast to become profitable over the next 3 years, which is considered faster growth than the savings rate of 2%. Now, analysts are expecting a growth of 41.60% for next quarter, a growth of 84.70% for the whole 2021, and 27.50% for the whole 2022. But again, they are not expecting this company to be profitable anytime soon, as they're expected to report loss per share of $1.38 on 2022, but again, they are not expected to be profitable until 2023-2024. So at the moment, I'm investing in this company. I currently have a position in it, which I'm currently down 14.87%. I have an average cost of $177 per share, and it represents 5.50% of my portfolio. I have to say that I started investing in this company when it went below $200, all the way down to $139 per share. But because I invested more at the beginning, we can see that the average cost is a little bit high. I'm not planning on investing even more in this company, as it is already a 5% position in my portfolio, and I already have a lot of risk in my portfolio right now. So I'm not going to add more to this position, but I'm going to hold it long term. Now I'm gonna leave you here my top 10 performers in my portfolio if you wanna go and watch it after this video. Thank you and see you next time.